Hello, everyone. Welcome to the Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and have a beautiful retirement. What could be better than that? I'm one of your co-hosts, Ben Barzideh, and I have my co-host, Matt Nadeau here.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here in Barrington and serving the greater Chicagoland area. And our fiduciary obligation to put our clients first is the tenet of our company philosophy, and it guides every decision that we make. As an independent firm, we truly have the freedom to focus solely on you, not some corporation.
And as always, we want to take a moment and just say hi to all of our clients who are listening today. We appreciate the trust that you place in us. And of course, we love every one of you. And we have a great show planned today, so I just want to get into our topics. In this segment, we are going to focus on, some of the market events this week. Obviously, the Fed came out, they cut rates. We're going to talk about it. We're going to bring Oracle back up and really talk about some of the opportunities and risks, specifically in AI. And then later, when we have our show next segment, we're going to talk about some of these weird inherited IRA rules and how to navigate through those.
Before we start, we also encourage you to follow our BN Wealth social media pages on Facebook and Instagram, and also encourage you to check out and subscribe to our economic update newsletter each week. It's called the 5-Minute Market Brief. It's extremely informative, succinct, and easy to read. You can sign up for it on our website at bnwealth.com.
All right. Well, let's get into this first topic and the market events of this week. So obviously the Fed, it's always about the Fed. They met. Their decision this week did meet expectations, although there may have been a slightly dovish tilt as the Fed cut rates, the 25 basis points as expected, and the median dot showed another 2 rate cuts between now and the end of the year. So if we look at the actual statement that the Fed came out, they had 2 surprises in there. First, we're looking at the words here, the second paragraph, the Fed acknowledged the softening labor market. And they added a sentence, and it says, quote, downside risks to employment has risen. And this is important because the Fed is basically telling us it's now more worried about economic growth than it is about inflation. And that's why we think it's dovish.
Second, the forward guidance in the statement saw also a dovish change, as the Fed signaled to the markets that this is not a one-and-done rate cut, and more rate cuts are coming. I guess better late than never, Jerome.
Better to be a few rate cuts than just one time and run, Jerome. Come on, buddy.
Too late, Powell. Tough job that guy has. All right, now switch it up a little bit. So talk about how Oracle earnings last week explained the opportunities and the risks we're seeing in AI. And it's not every day you see a nearly $1 trillion market cap stock surge 36% in one day, but it happened last week. And importantly, the Oracle earnings report provides a clear blueprint of 1, why AI has been such a positive for the market and the economy, and 2, the risks associated with it, because if AI is indeed a bubble, it is a big one.
Whew, yeah. But let's just look specifically at Oracle's results. And the reason that the stock rallied despite missing the earnings and revenue was this backlog, right? All of these promises of future orders. And it grew by a mind-boggling amount, exploding higher. It was $455 billion versus expected amount of only $159 billion. That's a year-over-year growth surge of 359%. So more directly, we're looking at these multi-cloud revenues from big companies out there, right? We're talking Amazon, Google, and Microsoft, and those rose specifically by 1,000.
Insane.
In fact, if you look at these major tech firms, Microsoft, Google, Amazon, Meta, OpenAI, they're actually spending more than $500 billion on AI infrastructure over just the next 2 years. So for context, that expenditure is more than what was spent on the entire TARP bank bailout package during the '08 financial crisis.
Just insane. So this has 2 impacts on the markets. First, the massive spending by these large tech firms is is actually acting like a mini stimulus plan for the tech sector and the whole economy in general. But it's gone beyond that. Networking, cloud capacity, data centers, natural resources to cool down these data centers, and electricity are all second level beneficiaries of this historic investment by the major tech companies in an AI future. And second, the surge in Oracle and its backlog numbers provides an important reminder of the incredibly high stakes in this AI movement. Put plainly, it better work.
It better work at this point. And it's also revealed here's something interesting in that earnings report. One specific customer, and this is OpenAI, was responsible for $300 billion of the $455 billion backlog all by itself. And having one relatively new AI company responsible for that amount of a backlog, that is what we would consider concentration risk. And remember, backlogs are not actual money. These are promises of orders that, they could cancel it at any time. So, bottom line, concerns about AI and some of this bubble is valid. If it's not adopted as quickly as companies assume it will be, and it doesn't provide the economic benefit in the immediate term, then much of this massive investment will appear wasted. And that's actually a substantially negative for these magnificent seven stock prices, the tech sector, and alongside that, the S&P 500, due to their weighting, and then the entire economy could also fall. All of this could cause a big market crash.
I had to bring something else up too, but the AI argument, whether it's a bubble or not aside, $37 trillion of national debt that we have with no end in sight is a massive risk too. And if we don't rein that in somehow over the next few years, that could be a big disaster for the economy and the markets as well. So that's why we feel that if you're in retirement, it's paramount to have a defensive plan with your investments, a disciplined sell strategy to exit the stock market if the risk of a crash gets too high. And in our Advance and Protect tactical models that we manage for our clients, we have a plan of attack for both bull and bear markets. If the market continues to go up like it is, then we'll just keep riding this trend. We have a motto, the trend is your friend.
Yeah, ride that trend. And in fact, that's where we have some of our more growth oriented models. And we just go pedal to the metal. Right now, they're 100% in equities because all three of our major buy and sell signals that do a diagnostic check on the health of the market are all positive. But of course, if the market gets riskier, and conditions deteriorate, then we'll do something about it. We'll actually get more defensive by starting to sell out of some of the stocks and going heavier into safer assets, hopefully like bonds or cash. And that's while we're waiting for conditions to improve. So we definitely feel that in retirement, it's not the time to be riding a potential market crash all the way down to the bottom and watching your hard-earned money dissipate.
Having a process to limit the potential losses in a portfolio is paramount to us, like you said, Matt, and hoping for the best, but also have a plan for the worst. And we consider it part of our fiduciary duty of looking out for our clients' best interest and doing what's right for them. So, do you currently have a defensive plan to help protect your hard earned money from a potential market crash? If our investment philosophy resonates with you and you're looking to have your money managed like that, then look no further. So if you would like to learn more about our Advance and Protect process or to explore becoming a client, all you have to do is contact us and schedule a complimentary consultation. We'll go over your current financial situation. We'll go over your goals. If we can help you, that's great. If we can't, that's okay too. We'll still part as friends. And you can reach us online at bnwealth.com, or you can always call our office at 847-780-2980.
And I'm going to tell you another reason to call our office, because we have some exciting news, Ben. In just a few weeks, we're having our first high-end Bordeaux wine tasting workshop. Not Bordeaux, Ben. Bordeaux, right? It's our last names, Barzideh and
That's
Nadeau.
right.
Yep. And it's going to be fun. This event is for those of you out there who've been listening to us, and maybe you're considering potentially working with us. This is a very low pressure, fun environment where we'll give a 15-minute presentation on how we can help you. and what makes our firm unique. There'll be some food, some wine from the prisoner family. It's October 23rd from 6 to 7:30 p.m. right here in our office in Barrington. So go to the website or call our office at 847-780-2980. All right, we'll be right back. Welcome back. Thank you for tuning in. This is the Money Hour Radio, a show where we try and help you grow your money, pay less taxes, and of course, have a beautiful retirement. I'm one of your hosts, Matt Nadeau. I have one of my other co-hosts with me, Ben Barzideh.
Hello, everyone.
And of course, we're both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here in Barrington and serving the greater Chicagoland area.
Company motto, by the way, is do great work, have fun, and give back. And we believe that with prosperity comes charity and value supporting churches or other charitable organizations that are helping the local community, especially our community. Therefore, we are so excited to announce that in the upcoming weeks, we will be launching the philanthropic arm of our company. We call it BN Giving. And we don't just talk about purpose. We actually want to invest in your purpose with you. So if you become one of our clients and you're a faithful tither or a regular giver to a charity, as long as it's an official 501c3 organization, just let us know and we will match your donation up to 10% of the management fee that you pay us each year.
And we really are hoping by working together that we can magnify our impact. And this is a whole movement where we're pioneering this unique aspect that's for our firm and our clients. And it's based around a culture of giving and a more altruistic way of doing business. And if we can grow our client base with like-minded people, those who share our values and vision, well, that's incredibly rewarding to us. And of course, by the way, if you're not a regular giver, hey, that's fine too. We'll still be happy to work with you. So if you want to explore more about this, our philanthropic journey together, you want to learn more about giving and how to become a client, reach out to us online at bnwealth.com or call our office at 8.
All right, let's now talk about navigating inherited IRA rules. And the only person that can roll a deceased person's IRA into their own name is a surviving spouse. For other beneficiaries, like our kids, for example, the best option usually is to open what's called an inherited IRA account. But they also come with complex tax rules that beneficiaries must understand to avoid costly mistakes. And depending on when the original retirement plan owner dies, some of these beneficiaries have to pull the money out in 10 years while taking required minimum distributions for the first 9 years. Some have to pull the money out by year 10 with no RMDs in years 1 through 9. And some get to pull the money out over their life expectancy. And there's even a beneficiary group that gets to stretch it out over their life expectancy until they reach age 21, at which time they have to switch and follow the 10-year rule. And it's enough to make your head explode, but we're going to try to simplify it for you today the best that we can.
Yeah, so like you said, Ben, if you're a surviving spouse, that's the easiest. But for everybody else, we used to call this the stretch IRA, an inherited IRA. And before 2020, non-spouse beneficiaries, again, like your kids, they could actually stretch out these distributions from inherited IRAs over their entire lifetime. And it would allow for this extended tax-deferred growth. And this strategy was especially popular for passing wealth across generations. However, after that, there was a Secure Act rule that passed, and it replaced this with a much more rigid framework, which we like to call the 10-year rule. And under this rule, most non-spouse beneficiaries are forced to fully deplete the entire inherited IRA within 10 years of the original account holder's death. And this change significantly compresses this tax deferral window and can lead to higher taxable income, especially during this distribution period.
So next is who must take annual required minimum distributions, like we mentioned earlier. Well, the biggest point of confusion since the Secure Act has been whether beneficiaries must take annual required minimum distributions during this 10-year window. And the IRS has not clarified. Here's how it works. If the original account holder had already begun taking required minimum distributions before passing, the beneficiary must continue annual required minimum distributions based on their own life expectancy. And these required distributions must be taken out each year, and the account must still be fully depleted by the end of year 10. Now, if the original owner had not yet reached required minimum distribution age, which is 73, beneficiary may have more flexibility on withdrawals in year 1 to 9, but the account still must be emptied within the 10 years.
Yeah, and there are a few exceptions to this 10-year rule that they put into place. So it's important to realize not all beneficiaries are treated equally. So there's something we call eligible designated beneficiaries, EDBs. And these are the people that basically get to still use this lifetime stretch method. So we're going to start with surviving spouses. They can stretch it out for the rest of their life if they want to at that point. Minor children of the account holder until age 21, not grandchildren. It has to be minor children of the actual account holder. Individuals who are chronically ill or disabled. And the other one is beneficiaries not more than 10 years younger than the original account holder. These individuals can take RMDs over their own life expectancy, and they preserve this favorable long-term tax advantage of the inherited IRA.
Now, there are some strategic considerations for beneficiaries, and understanding these rules is essential, not just for compliance, but for smart tax planning. And so here are a few tips. You want to coordinate withdrawals with your income. And since you have flexibility, taking larger distributions in high income years could push you into a higher tax bracket. So you want to be careful of that. If there's flexibility, you want to take those distributions, higher ones in years where maybe you have a lower level of income, and manage that. The other thing that makes sense is to consider Roth conversions while you're still alive, because if someone inherits a traditional IRA and they expect rising income, if you convert portions to a Roth IRA, that may reduce future tax burdens for them. And you also want to work with a financial advisor that understands these laws. The nuances of R&D calculations and tax implications make professional guidance invaluable in this area.
And I know this is just a short segment we had today, and you can just see from all of the different nuances of when you do have to take RMDs, when you get to stretch it out over your lifetime. Like, this is where you do need to have a professional who understands these rules and somebody who stays on top of the rules as they change, because there may be more favorable opportunities. But there's a lot of benefit of working with a professional like us if you're somebody who will be at some point passing that on to your heirs. There's stuff you can do now to help minimize that tax impact on them. And then if you're somebody who is going to be inheriting money, you need to understand the rules to best benefit you for distributions and how to manage it. So these things are critical, especially when you're working with a professional like us, where we coordinate all this as a family, as a group, working with your beneficiaries. It's extremely important, Ben.
And by the way, how this works is when we pass, our children are the ones, if they want to do an inherited IRA, that choose that election. Now, if you want, while you're still alive, there's a way where you can force your children to elect that more responsible election designation versus just leaving it up to them, where they could willy-nilly just cash out all your money in 1 year when you pass it to them. So an inherited IRA trust is where you can get what we call control from the grave and make your kids do the responsible thing.
Yeah, of course. Sometimes you got to force the kids to do the right thing. And not an official announcement, but with our firm, Barzideh and Nadeau Wealth Management, one of the things we do is we educate our clients on things like this. We're going to be holding a beneficiary client event early next year, I believe we're kind of targeting, because this is so complicated. We're going to bring our own clients, and if they want to bring their beneficiaries and their families to this event, where we'll walk through this so that it's a meeting of the minds. A lot of times it's difficult to talk about these things with your kids or talk about these things with your heirs. And we make it a fun, easier environment. We teach them, we teach you. So stay tuned. You'll hear more about that as we get probably closer to the end of the year. But again, if you're looking for a good financial advisor, somebody who can help you with this, I think we're as good a place as any to figure out some of these tips.
No doubt.
Yeah. So anyway, before we also wrap up this week, we've been announcing again in a few weeks, we're having our first high-end Bordeaux wine tasting workshop. Not Bordeaux, but Bordeaux. Get it? Our last names? Barzideh, Nadeau. All right. So it's a fun event. It's solely for new people. those who've been listening to us and are considering potentially working with us. It's a very low pressure, fun environment where you can meet us, drink some amazing wine, and we'll do a quick 15-minute presentation on how we can help you and what makes our firm unique.
By the way, we'll have some food and some of our favorite bottles from the Prisoner family of wines. That's the theme for this event, Prisoner. And it's on Thursday, October 23rd from 6 to 7:30 p.m. right here at our office in Barrington. It should be a ton of fun. To register for this event, you can call our office at 847-780-2980. And also to explore becoming a client, contact us and schedule a complimentary consultation. We'll go over your current financial picture and your goals. If we can help you, that's great. If we can't, that's okay too. We can't help everybody, but we'll still part as friends. And you can reach us online at bnwealth.com or call our office at 847-780-2980. Well, you know what? We're out of time. God bless you, and we will see you next week.